ZEDA, connecting humanity.
Good morning, ladies and gentlemen. Welcome to ZEDA's annual results presentation. My name is Babalwa George. I head up the investor relations portfolio. I'm the facilitator for today's session, and I will be taking you through the agenda. Today, we publish the FY23 annual results. 2023 was our first year of trading as a separately listed entity on the JSE. It is also a year where we navigated the impact of the unbundling. As we were mitigating the risk of the unbundling, we also successfully captured the opportunities. To unpack this further, our Group CEO, Ramasela Ganda, will take us through the business overview. After the business overview, she will hand over to Thobeka Ntshiza, our Group FD, to unpack the financial performance. Thobeka then will hand back over to Ramasela to conclude the session by taking us through the trading update, by taking us through the strategy update and the outlook. I will come back and open the floor for questions. Without further ado, I would like to call on stage our Group CEO, Ramasela Ganda.
Thank you, Babalwa. Good morning, and thank you for joining us this morning, as we will be taking you through our maiden full year results for the year ended 30 September 2023, after a successful listing in December 2023. A year it was indeed. It started with a lot of opportunities, with international travel coming back to our shore, especially Namibia and South Africa. New vehicle sales returning back to normality. That meant for us, our leasing customers will now have fleet. We can now manage back our residual value, mileages, and time. For the car rental, it equally meant that we can now buy the fleet that we want to procure, but not necessarily what is available, which was what was really the case in the last 2 years. There was always going to be a downside to the vehicle recovery, and that was the decline of the used car margin. We've seen unprecedented margin increase during those periods. So we did enjoy the past 2 years. However, this was exacerbated by a high inflation environment, high interest rate, impacting and putting more pressure on consumer disposable income. In addition to these macro factors, we had to navigate, as Babalwa has said, the impact of unbundling. Key was a potential loss of a broad-based Black Economic Empowerment rating level 1 from our previous shareholder about to lose the Black ownership. We had a very expensive unbundling debt, and that during the period where we were gearing ourselves to take opportunity of an increasing demand in the car rental. And in addition, as we've indicated, our growth strategy in the leasing business. In short, 2023 was a very tough trading environment. Despite that, the robustness of our integrated mobility strategy, focusing on diversified portfolio, our capability that we have demonstrated coming out of COVID, the discipline of the team in executing on strategy and cost containment has delivered the stellar financial performance. Our revenue, 12% up to 9.1 billion. This is $1 billion more than prior year. Driven by very strong car rental and leasing business. As we have previously indicated, with this diversified portfolio, we will be able to mitigate the risk of a decline in the used car margin. The decline in the used car margin was always anticipated, and our 2021 strategy has already foresaw that. And if you look at our business and you look at the margin that we've delivered, revenue grew by 12% and EBITDA by 18%. We were deliberate in making sure that our growth are value accretive and not dilute margin. As you can see, EBITDA margin of 36% coming from a 35%. This is despite the decline of 5% in our used car margin. The quality of our earning continued to improve with our operating margin of 17%, 100 basis point up compared to prior year. We continue to deliver sector-leading return on equity at 37%. This is 400 basis point higher than the prior year. The 2022 restructuring of ZEDA has enabled this management to ensure a capital structure that is fit for our business. In this high interest rate cycle, our weighted average cost of capital is at 12.8. And in my history, and as Tobeka continued to say, we've delivered return on invested capital of 18.7. That is just under 600 basis points above our WACC. We do execute with intent. And because broad-based Black economic empowerment was our risk, we made sure that we have a focus. And I'm glad to say we've attained BBBE level 1 on our trading and operating entity, which is a car rental entity and the leasing entity. This is our license to trade. And I'm really glad that taking into account all elements of procurement, of supply chain, we have managed to deliver. We've early settled the unbundling debt. We further developed and presented to our board an ESG strategy with a vision to responsibly drive the way to a more sustainable future. And as many of you may have seen on Friday, we're very excited when Moody's released the note that for the first time as a listed company, we've been credit rated. And not only that, we've achieved our investment grade. Our Group FD will unpack because this is very important for our growth strategy. We continue to deliver our growth with all the other things we've done. Our growth strategy is still well positioned in making sure that we retain and grow our leasing customer. This is the base for our annuity business. Furthermore, key to drive our usership economy is the expansion of the subscription offering. As many of you may have had, I hope, the introduction of a long-term leasing for individual. I will unpack it later. We have corporatized the van rental business. What does that mean? Some of the van rental that we have corporatized, those were sub-licensees and we were getting a fee. Now, we're bringing the entire business in. We're taking into consideration the synergy of bringing the business together and deliver with the same rigor and vigor that we have delivered in all our business. So we are well geared to make sure that we deliver even better margin out of this business. Solid performance, as I've indicated about our ESG strategy. Most of our brand ambassadors spend their time on the road with high level of excellence. And I'm truly grateful that in the year that we've just passed, the leadership and the brand ambassadors, they've taken heed to a culture of safety first. And we have improved our lost time injury frequency rate from 0.55 to 0.18 compared to prior year. This is among other reasons why we have partnered with Discovery Insure in order to fix the pothole, to improve road safety. We're fixing 4,500 potholes a month. We continue to look after the security of our resident and international travel by deploying patrol vehicles in high-risk areas. I'm sure you'll be tired of this word when I finish presenting, but I can't help myself to say I am still excited. I'm very excited that we've delivered our first batch of 10 EV 4-ton trucks to our last mile customer. And not only that, our hybrid vehicle growth of 36%. Moving on to the segment. Rent-a-car delivered a very strong performance with revenue up 12%. The major contributor was the inbound, as I've indicated, the excitement at the beginning of the year. Inbound at 108 and commercial at 28, corporate at 28%. A steady and sustainable growth that we've seen from our replacement business, public sector, and we continue to drive growth in our subscription segment. The discipline on managing out-of-service fleet and making sure that we've got our cars on the road have yielded positive results, even with an increase of 17% on average fleet, with our utilization at 74%. That is within our target range of 73 and 75%. Moving to the leasing business. Exceptional performance from a leasing business, with revenue up 13% to 2.5 billion. This is really underpinned by a great performance. If you know that part of the fix was some of the Greater Africa, the superb performance that we've seen from Greater Africa was really pleasing. And heavy commercial surpassed expectation. But our focus on corporate leasing is yielding the results, with us continue to deliver a solid growth out of this business. Leasing has got a strong EBITDA margin, with an EBITDA margin at 59%. That is 300 basis points higher than last year. When you look at this business, we have diversified even within the leasing business with asset-light business, the maintenance upfront, and that has positively still contributed to this margin increase. The talk of the town of the year, car sale. A very resilient performance coming out of this team. Our business have generated 2.7 billion cash, which is 6% higher than prior year on a similar size of fleet, with mix slightly different. Our strategy of growing the retail business yielded positive results, with revenue from retail at 4.4%. Retail gives us the ability to generate more second gross profit, to sell more value added. And we believe that even during this tough period, when everybody was selling, that we sell deliberately at the right margin. Our capability, forward-looking, and a good product mitigated against what could have been a significant decline in the used car margin. At this point, I would like to hand over to our Group FD to take you through the finance overview.
Thank you, Ramasela, and good morning. It is a pleasure to be presenting to you our inaugural first financial result as a listed entity, financial year September 2023. I would first like to start by unpacking our operating segments for you. What we have shown here are how we split our operating segments, being car rental and car leasing. And let's start by unpacking the average fleet. It is undeniable that we have seen a fleet size decline. If you look at 2023, our fleet size on average being 54,000, delivered by car rental, car leasing, and the disposal of used cars. In 2022, we were sitting with 51,000, so we have seen a growth of about 3,000 units. But importantly, if you look at 2019, before COVID, we were sitting on average with a fleet size of 74,000, generating revenue of 10.2 billion. And yet, when you look at this picture of the fleet size and you compare it to the earnings that this business has generated, operating profit at 1.552, exceeding 2019 levels of just under 1.1 billion, and delivering almost 400 million more with a fleet size that is 20,000 less. This picture tells us that, yes, whilst indeed we have lost fleet size from a leasing business due to the natural attrition of some of the contracts, and yes, while the car rental business has not refleeted itself up back from the 2019 levels, the vehicles that we have invested in today, the operating assets of today, are more profitable and more value accretive than the fleet mix that we had in 2019-2020. In the next slide, I will be unpacking those revenue categories for you. We have been measured in how we are fleeting today and how we are going to be refleeting into the future. We are going to be investing in businesses that continue to sustain margins, and we will not be chasing size or big fleet at the expense of not having a sustainable and a profitable business. On the slide, we unpack further our revenue categories, really split into four main areas of car sales: rental, leasing, commissions, and other. And what this picture tells us, and is important for me to really unpack, is first, it speaks about the strength of our diversified revenue streams. It has been a concern in the market that our business is heavily reliant on revenue from car sales, and that any impact or decline in car sales is going to significantly impact our revenue and the ability to sustain our margins into the future. And if we look at the car sales, yes, we are 36% units sold down when you compare to 2019 and you look at 2023. But this is a product of the fleet that we have on hand, which is a fleet that matches the demand from a revenue perspective. And the car sales business is an extension of the fleet that comes out of the leasing and the rental business. And as those units increase due to the revenue increase from the demand, we will see a correlation in more and more units being sold from the car sales business. And yet we are very pleased that notwithstanding the challenges of 2023 trading environment, the softening of the used cars market, this business has only seen a decline of -2% year on year. It is also pleasing to see that if you look at how the revenue categories stack up, you are starting to see a better evenly split of revenue contribution coming from car sales, rental, and leasing. In 2021, we saw the highest contribution of car sales in our business at 3.9 billion out of the 7.6 billion that was generated. That was at the height, over 50%. Since then, we have grown other revenue streams of leasing and car rental that the contribution of the car sales business is at about 33%. And you are seeing the growth and the recovery coming from rental and leasing becoming more pronounced and providing a balanced portfolio of how we generate revenue. If we unpack the car rental business, seeing the single most biggest growth in our business at 29%. Ramasela has explained how we've seen some strong recoveries from inbound. But what is even more interesting is if we unpack how many rentals we saw 2023 compared to 2022, we had 129,000 more rentals, more customers coming to our branches, booking our vehicles online compared to 2022. For us, that is important because it shows the activity levels. It shows that our value proposition to the market is accepted and it resonates with the customers, that we are seeing a growth in the customer base, generating increased activity levels that has supported the growth in the car rental business. When we look at the stats, we've also seen that we have rented out a vehicle every minute of this financial year. Last year, we were sitting below 1 vehicle per minute. Today, it is 1.2 vehicles per minute. And again, I think this speaks about the growth in terms of the actual activities sitting in the car rental space, supported by our drive to entrench usership economy and the extension of the subscription model. Our leasing business, this is the one area that did have a pronounced decline in terms of the fleet size, coming from the termination of some of the major public sector contracts. And whilst having that background in context, we have seen this business generate revenue of 2.2 billion, already exceeding 2019 levels with a lower fleet size. It does indicate that the work we've done to reposition our business for the future, introducing new customer segments, looking at how we close the gap that has been created by some of the challenges in terms of the distribution via the rail ports, and also the support of the last mile industry, going into supporting those customer segments, introducing a different fleet mix into our leasing business, contributing to this growth. And it is on this base that we say we are now really set for greater returns in terms of the additional products that we are going to be introducing, iLease being one of them. The finance costs were seriously one of the biggest areas of focus for our business. We understood that our business is debt financed, our assets are financed by debt, and we are going to have to make sure that our vehicles, as they generate earnings, profits, they are value accretive to be able to fund their own financing cost and also deliver returns to the shareholders. And while you look at this picture in isolation, could be scary, I think when you look at how we have delivered on earnings against this backdrop, it does speak testament that our business principles and fundamentals do work, and ours is to continue to make sure that we use debt responsibly, and each debt is matched to an operating asset that generates returns for our business. We saw our financing cost go up by almost 70% year on year. Just in the 2023 financial year alone, we were impacted by a 200 basis point in the increase of the prime rate in our country, with our net financing cost closing at 576 million in 2023, average financing cost of 11.4. I have included how did our net debt levels look like over the same period. And you do see that we closed with net debt of 4.8. Last year, we had a net debt of just under 4.2 billion. These 3 years, on average, works out to an average net debt of 4.5 billion. And this picture is important for me because it says, yes, we are a business that uses debt to fund our operations. We are a business that has grown the fleet. But the growth in the net debt to support our investment in the operating asset had less a pronounced impact on our net financing cost than the changes in the prime rate of the country. And ours is to make sure that we continue to use debt responsibly to be able to support the financing cost that goes with that responsibility. I've put on the table for you our effective tax rate reconciliation and a walk forward really from 2022 to 2023. We do have an effective tax rate of 21% for this financial year, coming off a high of 35.4% in 2022. Our 2023 financial year has had the benefit of a credit coming through from the over provisions of the previous year taxes, and they really arose from the previous business segments that we're winding down and final disposal entries as we now cleaning up our org structure for ZEDA Limited into the future. We will continue to have non-deductible expenses that impact our business, with the details of what impacts our non-deductible expenses provided. And we will continue to have withholding taxes in our effective tax rate reconciliation. And this is due to some of our presence in the Greater Africa regions, where we do have the impact of withholding taxes as we transact. We expect that our interest rate, our effective tax rate will normalize at about 28 to 29%. If you take the non-deductible and the withholding taxes, that will be something going into the future. we have generated robust earnings, boasting an increase of 30.7% on our basic earnings per share to close at 387 for 2023 financial year, and headline earnings per share 381 cents, 17.2% up on headline earnings per share. This is a very impressive picture when you remember the picture from the net financing cost, having increased our interest cost by 70% and still be able to generate these earnings for our investors. We have established our weighted average cost of capital to be at 12.8% for ZEDA Limited. This is already taking into account the existing funding packages that we've raised for ZEDA as a standalone business. And with those invested capital, we have generated a return of 18.7%. And we do say it's a record high for our business. Sector leading return on equity at 36.7% really does speak to the fact that we do use debt to be value accretive for ZEDA and for our shareholders. And we will continue to make sure that in our capital allocation, we balance our capital structure to be able to then reward the shareholders and the financiers that support our business. Earlier, I spoke about demand-driven fleet growth, and this picture is a summary of that. Our operating assets, if you look at fleet assets rental, fleet assets leasing, our fleet investment has increased by 1.7 billion in 2023 to close just over 9 billion. And when you look at that investment and you compare it to the net debt level movements, it does indicate that we are an organization that generates cash well internally. We do have equity embedded in each cycle that we plow back into the new cycle before we tap into debt levels to support our investment in the operating assets. When we went to market to raise funding for our business, we were also very deliberate to say, how do we start matching the finance profile to the assets that are matching? And this picture at the bottom, financing split, just gives you an indication of short-term debt financing in our total debt levels, making up 53%, and that is commensurate to our operating assets of the rental business, making up 55%. And that allows us to be able to make sure that as each unit is generating its revenue, its earnings, it is supporting its financing cost and its debt capital repayment. And the matching of that allows us to also continue to generate the strong cash. We are also very pleased with the improvement we've seen in the receivables, where in a business period where we have increased revenue by 1 billion, our receivables have declined by about 200 million, and we continue to have a concerted effort in collection policies and procedures to make sure that we reduce the age of our debtors. From an inventory perspective, having increased to 545 million, this is really a function of higher average values per unit that are on stock in 2023 compared to 2022. And it's not a reflection of how well we didn't sell in 2023. I spoke earlier about our embedded equity in each operating cycle. And this picture, I hope it demonstrates that to everyone that is online and all our other stakeholders. We have improved our company leverage to 53%. For every asset that we have invested in our business at 9 billion, it is supported by a lesser proportion of debt in 2023 compared to 2022 and 2021. And that just also confirms the position that I shared earlier, that in each cycle, in each vehicle, we've got embedded equity, that for us, the responsibility is to make sure that we indeed deliver on it, and it creates an additional equity pool for us to reinvest before we tap into debt to support and balance the additional required investments. If you look at our net debt to EBITDA, having improved to 1.45, and this again is testament of the value accretion that sits in each of our investment. The impact that we spoke about in terms of the net financing cost, it has been seen in a decline in our interest cover to 5.5 times. And we do believe that at this level, having gone through a 12-month of the steepest increase in terms of our financing cost, our interest cover and our net debt to EBITDA times can only respond better and more positively going into the future. I've been speaking about how we generate equity well at each reporting cycle, and that is seen in the equity closing for 2023, closing at 2.4 billion, having increased our shareholders' equity by over 700 million in the 2023 financial year. This has yielded a net debt to equity ratio of 33% equity, 67% net debt. We have further generated an extra 536 million in cash and cash equivalents to close with cash of 842 million for the year, contributing to our net debt of 4.8 billion for the period. From a strong cash generation story continuing, I've just unpacked how we allocate the cash in our business, having generated cash before working capital and decrease in working capital, that 3.5 billion mostly coming from the sale of the used car stock, with cash on those two buckets at about 6.8 billion. We have further then invested in our fleet for both businesses of about 6.5 billion just in the 2023 financial year. And this 6.5 is what the shareholders, our stakeholders, should be looking to in terms of what returns it's going to generate for the business in the 2024 and 2025 financial year and going forward. I have said we've closed with a net debt of 4.8 billion. And that 4.8 billion is off the back of our operating assets, fleet value on balance sheet having increased by 1.7 billion. Ramasela has shared, and I would like to echo her sentiments that indeed we are very proud and pleased that we now have our credit rating as ZEDA Limited, being an investment grade at national scale and being credit rated by Moody's, with the release having come out last week Friday. This really for us is also an independent confirmation that ZEDA is indeed a business to invest in. It is indeed a business that will be able to utilize debt to generate value for our shareholders and we are going to be a business that is going to do so responsibly. 2023 was really the year that we continued with what we started in 2022 in terms of raising funding for ZEDA Limited on a standalone basis, with total facilities closing at 9.5 billion for 2023, with a headroom to support our strategy into the future at 3.8 billion. We have been very fortunate with all our financiers, funders, really looking at how they will support the business. And really, the funding for us is a further testament of the belief that the investments in ZEDA will be the investments that are going to generate the adequate returns for all involved stakeholders. We will continue to look at how we diversify our funding, which we have started successfully in 2023. And that is for us to be able to say, as we look at all the maturity profiles across all the businesses, we balance the debt capital repayment appropriately over any cycle to make sure that there's no undue pressure into the business while we still honor all our financial covenants and all the obligations. I think at this point it is also important to confirm that we have met all our financial covenants and we will continue to do so responsibly. Ramasela spoke about the unbundling debt. We have generated enough cash to be able to settle this debt of 1.55 billion in the 2023 financial year, having paid 182 million ahead of schedule and completing the repayment profile 2 months ahead of schedule. We are also pleased that in the period of high interest rate, in the 12-month cycle, we did have financiers that said we will step in to be able to support you with a better priced funding cost, and you will then work the journey with us to the end of the financial year. And that work was also really to say, how do we minimize and lessen the impact of the funding cost for ZEDA Group as a whole, while we still make sure that we pay the full debt on time, if possible. And we now could see that it was indeed possible. And what would I like to leave our stakeholders with? That we will continue to be measured in how we fleet up. Our fleet growth is going to be demand driven, making sure that it is a fleet growth that is going to contribute to our profitable business and sustaining our margins. Our cost management culture and our discipline is going to also be something that is important to make sure that we look and manage it so that we do not have negative jaws that erode any profit margins for our business. And the team will continue to reposition our customer segments to really introduce how the customer segments are going to support our growth and be able to respond to what we would like to do in terms of entrenching the usership economy. And with that, I'd like to say thank you. I'd like to hand back to Ramasela.
Thank you, Tobeka. As I'll be taking you through what we have been entrusted with since 2021 and where we are today and what is next for ZEDA. If you cast your mind back to 2021 as we come out of COVID, or still in the midst of COVID, one of the things that we did, we developed a strategy on integrated mobility, created the very first integrated mobility solution provider in Southern Africa. Key for us was to reposition car rental business from what was previously known as a generator of a used car to be a sustainable business that is able to really look after everything and every aspect of that business. Profitable business was our key driver. Efficiency was what we were working towards. And the outcome of it was here for everyone to see. We equally did the same for our leasing business. We reviewed our business and looked at deals that were not profit enhancing or low profit margin transaction. And we restructured that as well. We repositioned our corporate business. We knew, as Tobeka was saying, the decline in 2021. We knew that public sector was coming to an end even in 2021. And we geared our business, the leasing business, to be able to be a sustainable business even outside the public sector. One other thing that we did, Tobeka saying for the first time this year, but just to help her memory, in 2021, she led the first diversification of our funding while we were still with our previous group. And for the first time, we had a floor plan in the car rental business. That was a small, in her mind clearly, step to deliver the outcome that we're seeing today. Fast forward to 2022. Many may not be aware, but we had the shortest period to gear ourselves for unbundling and listing on a stock exchange. And that didn't mean our strategy was to be left behind. We geared ourselves, we look at the portfolio that needed to be fixed, we look at our driven service, especially the luxury business, and we focus on building our own capacity to gear us for the 2023. We moved to 2023, took our integrated mobility strategy, enhanced it with the aspiration to deepen the usership economy. A number of pillars that we focus on. Fixing Mozambique, fixing Botswana. And I'm very pleased that the outcome of these two regional countries continue to be very positive. We had Ghana as well, and the operating activity in Ghana are really encouraging. Yes, the macro challenges are a big factor. And Tobeka and the team are really working to make sure that we can mitigate for that. We've enhanced, again, our aspiration on deepening usership in our region. We focus on long haul. We also focused on the last mile. Self-service was a key. But what was the outcome of all this since 2021? It's a double our earnings in 3 years, from 365 million to 742. Diversifying portfolio became very critical. Even then, for these results to be here today. When Tobeka said, if you look at the revenue in car sale, and you look at it today, that was the journey that we've been through. Our EBITDA margin was 29% with high used car margin, sitting at 36%. Granted, discretionary business at that time was very low. However, interest rate in those days of COVID were not a reason to talk about at all. ROIC, we're at 7.5 with a WACC of 13.75 with a DEN group. Today, WACC 12.8 at 18.7. And this is the company that execute deliberately, but more than executing deliberately, that also plan ahead to make sure that we're able to look for potential risk and opportunity and utilize. If you've been somewhere where no one else knows, you've never listened to any radio, you've never traveled anywhere, you must have missed this. The next level mobility is here. And this next level mobility is really driven by us deepening our usership economy. And this is iLease, which is a long-term leasing for individual. So what is so special? What differentiates this product from the rest? It's tailor-made for the user, for the user's mobility requirement. It is flexible. As Avis, as ZEDA, we've got all kinds of cars. So we are brand agnostic. But key is that you've got the best total cost of usership, because we understand that the market think about total cost of ownership of a vehicle that we've never owned. And we have been in the game of residual value risk, and this is not different for us. And in addition, we continue to push our Avis where you are, where you can get a vehicle anywhere in the world, in the country. Okay, I can see. Our medium-term outlook, if you look at it, we're still going to focus on a customer experience, but we understand that we do not have customer experience without looking after our brand ambassador. So key is to improve our value proposition to ambassador. And I've already unpacked what we've done with our EHG strategy, so I will not spend time. But key is our growth pillar. Long haul, last mile, that's where we're going to continue to do. A corporate leasing is our focus business. As I've said, Greater Africa, we have fixed the fundamentals of our own business in those countries, and we are geared for growth. When you look at the short term, on demand is where we're driving our business to. Self-service, Cape Town International, and OR Tambo are officially self-service business as I speak today. Driven service, don't think anybody have not seen a very proud brand ambassador chauffeur drive. Looking at inbound business, we're seeing a recovery. If I look at the forward reservations that are there, we're going to have a very exciting time. Corporate business equally the same. And we'll continue to expand on our subscription and digitalizing our retail footprint to gain more revenue from it on a car sale. As I conclude, looking at our capital allocation and looking at what the future. Yes, the environmental macro risk still exists. Interest rate will still be an issue. Disposable income will still be under pressure. If I look at new vehicle sales, our used car, after the 5% decline in the previous year, we still expect it to be still going down. And we've seen it, that's where the used car market is heading to. But despite all of that, with the corporatization of the rental, we will maintain our growth trajectory. I have no doubt that we have built a solid foundation to take advantage of all this opportunity. We will sustain our margin, and we will manage our net debt to EBITDA. In our pre-listing statement, we've indicated that our dividend policy of 20 to 35% of net profit after tax will start from 2024. And we are well geared and well positioned to get back into that and to deliver the sector-leading returns that we have been doing. Thank you.